Welcome everyone to the 9th episode of the Futurum Equities podcast. You got myself, Shay Boloor, aka Stocks Every Shy. We got Daniel Newman, aka Danny Dimes. We felt urgent that we should probably do a podcast, and a lot of you guys commented, yes. We gotta hop on and see what's happening right now in the software world. So, how are you doing, Daniel?
There's nothing better than validation of an idea in real time, right? Like, you want us to pop on now and talk about this, right? I mean, I woke up this morning looking at Monday, and I swear to God, Shy, I read that post you put up like 3 times. Like, I'm looking at it, I'm like, they meet, and they're down 20. Like, I'm like, what happened? I'm like, did the CEO quit? Are they being indicted? And then I'm like, no, of course it's not any of that. It's the fact that this is another SaaS company that's getting re-rated in real time, because that's what's about to happen to all these SaaS companies. It was, it's companies that are becoming features, and these people that have invested in them and ridden up this run in their prices. It's like, we got to re-rate these, which, by the way, is your favorite word. I'm using your word, but it wasn't bad performance. It wasn't a bad performance at all. So, I just said, Shai, we got to talk about this, because think about, we just published, the agentic platforms. I published a Forbes op-ed. You've been online talking about like why enterprise software was going to completely change. You had a great piece over the weekend. I mean, we're running on all cylinders. The timing couldn't have been better.
I mean, yeah, it's unfortunate that we were right, because there's a lot of software names out there. I will say this. Let me give my thoughts on the Monday.com earnings report this morning, because I do believe that sometimes it's over the top too quickly. Like, let's just go into the earnings report for Monday. Like, it was a very clean beat, like you just mentioned, Daniel. Like, it wasn't that much of. There wasn't any holes, except for the guide up wasn't as aggressive on the upside as the standard has been for that company. But their CRM hit 100 million ARR in 3 years. Like, AI adoption in their platform is continuing to expand. Like, there was no execution misses, but like you mentioned, this is just a repricing on the entire CRM narrative from that AI tsunami. You guys heard us talk about that last week, where the AI tsunami is coming for the whole software space. Who has the lifeboats right now that are going to survive it? The market's already telling you which 3 names are going to. It's going to be the Palantirs, it's the Cloudflares, the Axons. Everyone else, it's up for a rating. Like, they're in front of the AI tsunami, and it's a flip of a coin on who's going to survive and who's going to drown. And CRM space is going to be one of the vulnerabilities of that AI tsunami, because it's just so easily, it's so easy to get disrupted, where you're already seeing it right now through Microsoft, Google, and even ServiceNow. They are bundling a lot of these AI-driven CRM capabilities directly into their productivity stacks at no incremental cost. That's the important part of it, where they're getting that Monday.com features for essentially free. So that creates this kind of gravitational pull towards platforms that already control daily workflow entry. So when you think about that, it's the emails, the docs, the chat, the project spaces. And for a mid-market player like Monday, the question isn't whether or not their product is like loved or endeared. It's clearly, can they maintain pricing power going forward when there is a AI tsunami coming with that space? So entering this earnings report, like, they're trading at 40 times their free cash flow multiple. I think we're getting some clear signs this cycle on what's the mean multiple is going to be on the tier 2 and tier 3 names. It's going to be around that 25 to 30 times free cash flow multiple. You're seeing Trade Desk got re-rated around that similar level. Monday.com, it's at trading at 25 to 26 times free cash flow multiple right now. I think it's getting re-rated so quickly that there's probably going to be somewhat of an opportunity there in the near term, because it's not going to happen all at once. I think you made a post about this, Dana, where it's going to be a slow bleed. It's not going to be a flip of a switch, like recession. It's going to be a slow bear market in that whole space. That's going to take a long time to phase out.
Well, there are a couple of interesting reflections, I think, that most people out there, both investors and tech enthusiasts, can and should make. Your point about how fast the drawdowns happen now is actually pretty pervasive in the market. So like we've seen, you know, how quickly in April the tariff news created like the epic fall. That wasn't all based on what has happened. That was based on the new formulas plus the algorithms' expectations of what will happen to a market over time. Same thing's happening in a microcosm that can be an individual stock. You know, we saw it with Trade Desk. Trade Desk got a near real-time re-rating because basically it is being now sort of recategorized as an also ran in the advertising space as the big 3/4, you know, the Google, Amazon, Meta are sort of seen as the dominant market players forever. And then these are like the also ran player in the space. What does that, you know, how do I evaluate that? Well, why wait, you know, and draw down over 3 or 4 quarters? Markets are forward looking. So that's the second point. The forward looking nature of the market ends up having the behavior be based much more on what it's expected to be over a longer period of time than what it actually is in this moment right now. And so these companies are getting evaluated based on an expectation. And what I put out into the ethers was somewhere between 1/3 and 50% of SaaS companies today will no longer exist within 3 to 5 years.
Wow.
Say that out loud. They will actually no longer exist. This is not just a re-rating. This is a complete capitulation of an industry, because right now, you know, you can use Cursor and Lovable and a couple of other off-the-shelf, you know, vibe coding apps to build enterprise software that used to take years to build, and you can now build it in months, weeks, and that number will actually change to weeks and days. And then it becomes days and hours and minutes. And this is where it's going. So the whole business model is going to explode. So we've got this kind of this whole situation now where we have to look at how business models actually function in the AI economy. So that's why like CapEx intensive names like Nvidia, easy to rate. They sell a hardware product. That product is used. You can really understand that. Software is much harder to understand that. Because even if the software is super usable, so say any of these companies build an agent platform that works really well, like OpenAI, say it builds the super agentic app, okay, that can look across every part of the data corpus that you have in an enterprise, and it can give you an abstraction. What are they going to charge for that? What does the market model to drive revenue look like for that product? And what kind of profitability, and then who are the other players that benefit from that? So we're in this really interesting juxtaposition right now, this interesting inflection where all these companies that have made all their money on a per user basis, selling a service and then layering on more and more services per user and charging more and more. And then, by the way, raising prices every year, punitively almost, for what's supposed to be constant feature modernization and support. And now you're in a situation where it's all outcome based. It's all tokens, right? It's like I'm going to have Futurum is going to have 100,000 analyst agents that are going to be doing work all day long. What should I pay for that? What is that? How does that evaluate? What is the market software model? And of course, how quickly can you build it? And how easily is that disrupted by the fact that you've got these different companies that can all sort of use this open AI era platform to build these kinds of things?
No, I mean, I think I think you're just reiterating that the traditional SaaS playbook, like the dashboards, the seat-based pricing, all those multi-year contracts that are justified by just a slight feature creep that just got added onto it, it's collapsing with their AI native customers just becoming so freaking big now. And also, that's on one side. The other side is the hyperscalers. Like they're getting squeezed a bit, the software space, where it's not just hyperscalers. That's usually ever since the post-cloud boom, like it's always been software versus hyperscalers. But now there's another side, which was the AI native competitors. Now it's just like becoming a very noisy. And I do think that we're not saying that there's no value left on SaaS Av, for example. Like there is going to be value in SaaS Av. It's just the neighborhood is changing so fast that what worked just 6 months ago no longer maps to how software is going to be bought, deployed, or even valued today. And I think there's
value, answer this. Is there value on being on SaaS Avenue? Like, is SaaS Avenue like Cabrini Green now?
Well, no, I think there's three names that come to light that I think are the closest to being like the mansions on SaaS Avenue. Um, ServiceNow, full confidence in Bill on being able to get ahead of that AI tsunami. I think they're re-architecting its workflow so that AI agents can handle the end-to-end business process. Again, not just a little creep, little feature, but truly recommending what the next steps, not just recommending what the next steps
Yeah.
will be,
Say that fast.
recommending
Say that fast. Say that fast.
recommending what the next step will be, but executing them across all the different departments, like the ITSM, the HRs, the procurements. Like, I think that you have to ask yourself, that agentic cloud platform that we are launching a list next month, like, who's positioned on SaaS Avenue to benefit off that? I think ServiceNow is very close to that. It's becoming like Nvidia relies on ServiceNow, for example. That alone, in my opinion, provides somewhat of a life jacket for them to survive the AI tsunami. Maybe not like get a boat, but it's a life jacket. And I think that right now, them being traded at 40 times free cash flow multiple, people are wondering, like, why are they selling off after a stellar earnings report? I'm sorry to spoil it, but like 40 times free cash flow is a premium now on living on SaaS Avenue. Everyone else is going to be getting traded 25 to 30 times. 40 is a premium, and it's kind of fair value. Another one that I'm really worried about, I'm curious about your input on that after you talk about ServiceNow, is Snowflake. Snowflake is interesting because it's more of a data infrastructure rather than SaaS, but it's trading at 50 times free cash flow multiple. It's got a big matzo ball potentially if they disappoint, where if I think the status quo is going to be 30 times, that's a substantial, that's a 40% clip immediately. It could have a Monday.com trade desk like move if they disappoint. I don't think they will, because Cortex is gaining a lot of momentum. I think that Snowflake Intelligence is gaining a lot of momentum, but it's a risk there. So what are your thoughts on ServiceNow and Snowflake?
Well, where the data ends up sitting is a really interesting question, Mark, because the cloud providers all kind of do it. And then Snowflake's built this sort of best of breed offering. But here's my point about my question before I answer yours, because that would be, why would I answer yours if I could answer my own? That's media training, by the way, everybody. Just know that. SaaS Avenue becomes something else. That's, I guess, what I was trying to push you to say is, I've got this rise of the agentic platform companies, but like in the end, right, people, it's going to be sort of like we change how we identify. There was a period of time where like RPA was a thing, right? Robotic process automation. Everyone talked about RPA. No one talks about RPA anymore. It's not a category anymore. Now
what was that company that everyone used to, UiPath? That was the thing,
right?
yeah.
UiPath and Automation Anywhere, and all these companies become kind of workflow companies in the intelligent automation era, and really they become a feature set inside of Microsoft's Power Platform that allows for you to automate workflows. And so you go to a ServiceNow, and ServiceNow has been significantly disrupting its business model and expanding its TAM by getting into other SaaS areas. That's what has been doing the last few years, right? It got into HR, it got into customer experience, CX, contact center type customer support, and it's built a layer of CRM. Having said that, the mission, if you're talking to someone like a Bill McDermott or Mark Benioff right now, is to really not be seen as merely a SaaS company. And their biggest challenge, Shay, is going back to what I said, is the business model. So the business model has been user-based. And now these companies need to be action-based. And so they're putting it into some of their marketing. ServiceNow talks a lot about like chair swivels, the reduction of chair swivels, the control tower, the ability to sort of see across your enterprise data estate, low latency, real time, prompted, generative tool, the Now Assist platform. Mark's talking Agentforce. But the challenge is, and this is the real problem that businesses have during a significant market inflection, is that how do you move to the new model where there could be meaningful disruption to revenue streams while not imploding? This is why Kodak went out of business. They didn't get out of film soon enough. They tried to hang on to the working model for too long. This is why Blockbuster failed. They were getting into streaming. They were sending DVDs, but they didn't want to cannibalize the existing market. This is, you can do it end to end. BlackBerry. They didn't want to go to a next generation OS and touch panel. They stuck by the idea that a tactical haptic keyboard was going to be the way people would want to interface to their systems. So you just go down the list of every major disruption in an era, and it's kind of that same thing. So here we're at this point where it's like, if we keep charging companies on a user basis and companies get smaller and they go to tokenomics instead of a user-based economic of their business, how do you charge? And so they have to add the new layer of charging, but at the same time, they can't completely cannibalize the revenue. And this is, by the way, why they're all getting re-rated, is because they're not able to understand it well enough to articulate it, and the investors hate uncertainty. So what they're seeing right now is still good numbers. And that's why I say the only time you see selling like this when numbers are as good as they are is when people don't understand how they're going to get from where they are to where they're going. Uncertainty, whether it's the tariff sell-off or the Monday sell-off, is the factor. The only thing people know is that agents are coming for their business, and that just layering an agent on top of their existing platform ain't going to get it done.
So I'm glad you said that, because uncertainty does provide opportunity, though. And I think that what we're talking about is the end of this decade, what's happening in the space. Market's a forward-looking mechanism. Nobody knows how forward-looking. It could be 6 months, 12 months, 2 years. But if you look at the charts and a lot of the software names, they are oversold on the RSI. A lot of them, the re-rating has been so aggressive on a good print, like Monday.com, 25 times free cash flow. What do you think the bottom is on that stock? I don't know. Like, they have a Rule 40 score of 50 plus still, and they're still guiding for that for the next couple of years. So now their score is 2x or multiple. In my opinion, I think it's a little excessive right off the gates. So I think there's going to be some kind of bounce potentially on a lot of these names. Like,
that's fair.
What's the Monday, Elastic, Confluent? I think these names that.
Well, didn't Confluent get like wiped out because one of the cloud providers that uses
OpenAI?
That uses their tech. And I mean, that made sense though. That's material. Like, it's like if Nvidia said we're not going to go with Astera, like that would completely restructure the company's valuation instantaneously. Like, that was how dependent Confluent was on OpenAI as one of its biggest customers. So there is a difference there. But the thing is that you're saying that's important, Shay. These are not structurally broken companies yet. The problem is you got to put the comma and yet at the end of the sentence, because most people can see that there will be a structural break somewhere. And let me take my hat off as analyst and put my hat on as business owner. The minute I can use a system that looks and functions like ChatGPT, they can look across my data estate, they can navigate the private public data issues, right, of what can be shared externally and what can't, and they can basically abstract me the information I need, I will cancel every single one of my enterprise software agreements. Nobody likes their enterprise SaaS tools, except for the people the only fans that these companies really have in terms of their users tend to be the people that administrate these systems, because it's created this ecosystem of jobs. And this is true in cloud too. Like, if you go into, you worked at, a strategy guy at a long time in big healthcare, your company, there were probably some people that were the SAP people. And there were probably some people that were the Oracle people and some AWS people. And my point is that these people's jobs depended on the complexity, the customizations, the difficulty to use this stuff. If all of a sudden I was like, hey, Shay, you want to work on that strategy deck tomorrow? Just work in a prompt system. It'll figure out everything. It'll use all the high value data. It can actually extrapolate the insights. It'll look across all the video and training modules the company's ever done, and it'll put a deck together for you in the next 30 seconds. You wouldn't be like, yeah, you know what? I'd rather do 15 chair swivels and bounce between an HC, a human capital management, and an ERP system, and a CRM, and a project management tool. No, nobody would say that. They'd just be like, absolutely, give it to me now. I'll take it. Whatever it costs.
I think you're getting at that AGI is inevitable, and maybe that's why there's a ticking time clock now as well in software. That's a third risk. Like, do you think that's kind of accelerating this like FUD on the software space, where it's not just hyperscalers, AI native customers, it's also ticking time clock on whoever solves AGI will make a lot of these software features or middleware companies obsolete.
Look, our business in the research analysis business, like I'm not saying the business of having a profile and having an audience that watches you will lose value materially in the near term, Shy. But like the research you write, right? There's two things that make it valuable. It's one is the depth of your insights. Like you've invested the 10,000 hours to become who you are and to really understand these companies. And then it's the ability to explain things simply to people. But then the third vector of that is that you are seen as, by most, right? We all have our trolls, but you're seen as pretty well trusted. And there's an authenticity to it coming from you. Okay. And so like you look at how, because last week we talked about Gartner and McKinsey and these other bit, like SaaS is just another layer that's experiencing the same re-rating of business because of the expected impact that AI is going to have. The harder part for most people to digest is that you would have kind of looked at SaaS as something that would have accelerated to AI. And I think in the beginning phases of kind of AI, these companies actually got a kind of an uptick in valuation. They were seen as the big winners on more data. And now what's starting to happen is we're starting to see through some cracks. And we're seeing, like you said, that, could Anthropic, OpenAI build something like this that works better and more intuitive? Could one of the cloud providers that offer these A to A and MCP, these multi-context protocol windows that can work across, because it's not just AGI. I mean, MCP, which is basically the ability for agents to navigate against different softwares using APIs, it's pretty powerful. The thing that really keeps us all somewhat bounded in is governance. These systems have governance, and that's the logic that sits on top of the data to know, like, don't share Shai's salary information, his date of birth, or any of his HR records.
Well, let me ask you this though, then, because IBM has an incredible governance moat, or their mainframe is just nobody can compete with them. Is there an opportunity that these like Renaissance players have this opportunity now to acquire these like high quality software names that don't really have a future because they're tomato now? And now these like an IBM doesn't just have a Red Hat, they can get a lot of attractive like Elasticsearch, confident real-time streaming data. Who knows? Maybe even some kind of, I don't think so, but like a data lake or a data warehouse component. Like, do you think that's like kind of
they have data, they have storage, they have IBM Watson data, but look, not just IBM in general, but like, is there value? I think there's value in deep value in IBM's deep enterprise experience. Because this is the one thing that where an Accenture could do well, where an IBM could do well, is while I'm the first guy that's screaming like consultants are all screwed because like AI does a lot of that stuff, but that sort of deep domain and tribal knowledge. Because here's the problem with enterprises, right? The reason AI has proliferated so quickly in the consumer realm is because the data is all up for grabs. Meaning if it's been published on the internet, the LLM can be trained on it. And it can basically display that information, and they have all this sort of fair use. Now, all the data that's been built into these proprietary and large enterprise systems have varying levels of tenancy, right? Like this is what you're allowed to see. You're a senior director at UNH. You get this much access. You get to see these things. You're an executive VP. You see a whole lot more. You're a contractor. I can give you access to the system too, but you get to see this tiny, narrow little sliver. So there was a lot of like these kind of control layers that were in enterprise software, and that for it to work the way we want it to, with the control still in place, still is sort of not possible. So companies like IBM or like Accenture that have consulting arms, so they don't only have the software and the technology and the moat, but they actually have deep domain understandings of how these businesses' IT and data architecture looks, and then could possibly recalibrate that to actually enable, the protection of certain data, the availability of other data. By the way, doing all these things for different regions and different sovereignty components and different governance issues and policy issues, that's really hard. That's what's going to keep things afloat for some period of time. But it's like, when I say some period of time, you look at how fast this is moving, Shay. It's like 2 years, 3 years. It's not a long time.
Well, do you think, first off, because like Oracle had just a renaissance app in cloud now, OCI is just hitting on all cylinders. It's second wind, old as blue, like you always say. Do you think there's worlds where like Cisco's getting into security now? What's the adjacent theme next to security? It's cloud. I think there's a lot of high quality, low valuation software names that are under 5 times sales that they can like scoop up and all of a sudden have a cloud lane underneath their umbrella of business functions. I think that's where I'm seeing potential like lanes for like these IBMs, the Cisco's, where like the Elastics, Confluence, Sentinel Ones, etc. Like these companies are under $10 billion. I don't think they're going to be mid cap after that. They're stuck. They're just going to get acquired by these Renaissance players, and I think that's like an interesting tailwind for maybe investing in an IBM or Cisco, where they aren't expensive.
Yeah.
They have an incredible moat that can't be replicated. And now there's tailwinds of land and expand where growth might come back if they acquire a certain amount of assets necessary.
Well, some of them are kind of expensive, so we do have to keep an eye on it. Like, IBM trades near all-time highs. Cisco has gotten nearest its highs since the dot boom, internet boom. So people are seeing that these sort of kind of, what do you like to call them, but they're kind of like core platform layers of the AI build out. They're finding new ways to participate. So the Web 2 companies, the Era 2 internet companies that have
structural arteries,
are starting to find structural contributions to make in this era. Cisco, I think, has done it a lot around security, like the network, and securing the network is only going to become more complicated in the AI era. IBM's doing it on enterprise, domain knowledge, just has incredible enterprise domain knowledge. You're sort of seeing Oracle. Oracle did a couple things. Oracle actually kind of recreated itself and has a new posture and has been re-rated for this reason. But first of all, they bought they bought as much GPU capacity as Google Cloud, and they bought almost as much as AWS. And so when they were much smaller, they went all in on Nvidia. And that's just not a bad idea when you're looking to just sell out capacity. And so part of AWS's pullback, I think, has been Oracle's gain, to be very clear how that actually ended up happening. So Oracle also hit on a couple of other cylinders, of course, and got a couple of other things right, and aligning to the administration, doing Stargate. Even though Stargate itself hasn't been that successful, it just put them back in a different sort of, I always say the impact of like the right word choices and being categorized with the right
as a narrative re-rate
can change the way investors see you. I was pounding the table about Oracle company with almost 80% more predictable revenue when it was like $75. I was saying it was like a really great buy, really, because this is the kind of data, by the way, that you can't actually make your leap to the agentic era without. Like that is like the data that businesses are run on. Like some of the SaaS data, it's like, you could probably export most of your project management data and sort of put it into a data lake and use some tables and columns, and a pretty decent data developer can do something interesting with that. Your Oracle data tends to be like, you're talking like petabytes of enterprise data for large companies to have to sift through. So I do think there's a lot of merit in some of these old as new companies. But I also do think like acquisitions will be important. I tweeted out earlier, you saw me, but I tweeted out the whole, Salesforce should buy Monday. Because another thing that is that a lot of these SaaS companies are like, they do one thing. They were one feature. They created an entire company on being a revenue forecasting SaaS company, or an entire thing on just being project management. And if we are heading to this platform era, it's all going to be about kind of having everything in one estate. That's what the big hyperscale cloud providers are. Their infrastructure, their platform, and now they're adding SaaS, right? That's like Microsoft. There's the whole thing. For Salesforce, they don't have infrastructure, but they have platform. And they have the application layer. So if they had like a bunch of the best, like they did with Slack, like something that everybody really likes and everybody uses is going to keep them sticky in the next era. And by the way, we're a Salesforce shop with Slack, and most of my Salesforce views, Shay, are Slack. I use Slack Elevate to actually create views of my Salesforce data because I don't want to go into Salesforce. I just want to query the bot to tell me something like, tell me where revenue is at this week, or tell me which deals are set to close, or tell me, what events are the team at. So that kind of interface looks a little bit more like what I think most of us are going to want to use.
Well, I think it also reiterates why the breadth has been so bad right now in the market. It's the the big whales are maintaining. Everyone else is selling off because I think what we've been saying the past couple months has essentially been that to be a SMID and succeed in the new digital economy, you have to have an in-depth, like a moat that can't get replicated by a bigger whale. Like you have to not just look at the margins, for example, like Monday.com, exceptional margins, 50 plus score is elite. Look under the hood. Can that product get replicated? Can that code get replicated? Why is Cloudflare still getting it 100 times free cash flow multiple and their earnings was probably just as good as Monday.com's? You actually have to know the businesses now. You have to know what's going to fit in the new digital economy. You have to. And I think that in order for you to invest in a company under 50 bill, you really need to know more than just what the numbers are. You have to know how it's going to function. Can it compete? Can the bigger players replicate it? And I think that it's so tricky and noisy that it's going to take narrative changes take months to get past. Why is that? You need multiple earnings reports to say, oh, it was actually just fear where they're fine. So right now, the software narrative is poor. It's just as bad as it was 2 years ago during the business spending recession that we had. How long did that take to phase out? It took years because, again, in order for the market to digest that FUD or fear, they need to see proof in the pudding. And that's going to take at least 6 months, 2 earnings report cycles, probably 3, maybe even 4. And there is opportunity costs at play now. So even though I participated today into like these like tier 3 high quality software names like the Mondays, Confluence, Elastic, SentinelOnes, like they're short-term trades, they're rentals because I have too big of a cash position. My high conviction names, the Palantirs, Axons, Cloudflares, Rocket Lab, Amazons, like they're not cheap. They're nowhere close to being cheap. So I think there's value to use that working capital for some trades. But you need to view these names as rentals. You're about to say something, Daniel?
No, I'm just thinking like one is there's every inflection like this does present opportunities. And I think so for everyone out there, and Shay, you've got, a big base of people that look to you for your sort of trades and your plays. I've just started becoming more public with mine, because I got to stay unconflicted with all our advisory roles. But like in the roles where I do trade, it's like, what were the plays? Like Trade Desk and Monday, 2 good companies. So like I got hit up about like C3, and I told somebody just in private, I'm like, in my opinion, and of course this is not financial advice, but it's uninvestable. It's not a real thing. But like Monday's a real company, it's investable, but you have to have made the mental re-rating on it and say, where's an entry point that I still think it can be successful? And then the other question is you got to watch the market for, can they make a pivot? Meaning where you start to see that their narrative to the market is a pivot that you would want to be long in. Because the other problem that we all have right now is every investment we make has a choice to invest against something else. So for instance, every dollar I put into SoFi, I could have put into Robinhood. And so while I've had this great return, I spend a lot of time looking at the return on SoFi, and I'm like, well, if I had put all this in Robinhood, I'd be 5 times better. So what I'm saying is every time you make a decision to get into something, you're like, oh, this is a great opportunity. Well, maybe a better opportunity was just buying more Nvidia and doing nothing. I mean,
perfect. No, you nailed it because I had a post this weekend where I did a look back because I'm almost at my goal when I first started this Twitter 2 years ago. And one of the biggest regrets I had was choosing Trade Desk over Meta. I was like, I want the pure form of ad tech rather than just buying Meta because it was a $500 billion company. I wanted that alpha. I wanted that multi-bagger. Trade Desk, Jeff Green, a huge fan, great fundamentals. Value, like they were 20, 25 bill, 30 billion at the time. Like, I think there's better opportunity there. Schmuck. Right here. Schmuck. Look at me. Schmuck. I think like invest in the best. Doesn't matter the market cap. Ad tech, for example. Like that was my look back for that. Same thing with Nvidia. Nvidia and Broadcom. I was like, Astera Labs is like a 2x levered play on those names. Like if AI is what I think it's going to be and inference will explode, Astera Labs is the greatest moonshot for that. Why not do all 3? Why did I just choose Astera? I could have just reallocated more in AI. And MongoDB is a great example as well, where I think open source is dead. I think the structural tailwind that open source create for these companies is also the monetization headwind now, where the biggest customers are just essentially saying, thanks for creating this great product that we can openly use. We'll take it from here now. that's what's happening for a lot of these open source products. And I don't know about Mongo survival. I'm waiting. Atlas reacceleration. Great to see. First time in 3 years, 28% top line growth last quarter. We'll see what happens this cycle, but this is a less than 2% position for me now. And now I have to like ask myself, is it worth the software headache to just digest through for years when we're seeing how much the networking component of the semi ecosystem is on fire right now, and they're not giving us an opportunity to pull back, but just it's hard to not see where the winners are, like the Robinhood, SoFi's, Astera Labs, Broadcoms. Like these are clear winners for a reason. They have not pulled back at all.
Remember the saying about, because I like to make all my pick on the bears, right? Like, bears look smart and bulls make money. And sometimes this is a bull's version of that same predicament. So the bull's version of that predicament is we still try to be super smart with a bullish thesis, and you get into a name that's never going to perform as well as the real bullish name. It's, and by the way, like it's even the argument that most Nvidia bulls will have with AMD right now. And by the way, AMD's performing remarkably well, but they'll say like, why are you trying to get in with the also ran when you can run with the champion, right? And so, and then obviously time always tells, but like right now with Trade Desk, like I opened a position on a put spread like well below the money. Like I did 30 puts for January and I made like $1.50 a share, something like that. And I'm like, look, if I enter at under 35 in January, then, but even still then I'm really, if I'm being honest with you, Shay, I'm just making the trade because I don't expect it to go to 35. I'm just trying to make money on volatility. I'm not really even looking to own that stock. And so that's where I'm trying to be smart. But if I just put $1 into something that, as you can more confidently run. And then the other thing, like I said, is being too smart to basically just buy into great companies at whatever point. Mm-hmm. And this is like a lot of people yell at me. I got a lot of haterade on the internet that I'm too bullish, and that when Palantir goes back to $10, I'm going to lose people money. That's what they like to say to me. And I'm but the bottom line is like, look, I've told my story. I sold at 45. I bought at 9. So I got in at a great entry, paid 5 bag, felt great about it, but I don't feel that good about it right now. And the bigger reason I don't feel good though is when it was at 70 and 80 and 90, I had 5, 6 more chances to get in. Right. And I didn't. And by the way, now at 185, I'm still telling myself, people do this, by the way, they're doing it with Bitcoin. They're like, oh, I can't get in. There's people that think Bitcoin's going to go to $1 million, Shay. And what I'm saying is there's people that think that Ethereum is going to go to 30,000. But people are saying now that, Bitminers run and now that Ethereum's run, like, oh, I can't get in at 4,200. I don't want to be the one that got in at the top. And what I'm saying is when, with great companies that are structurally aligned, like we both sit here and we're like, Nvidia is going to have $1 trillion in potential revenue by the end of the decade. Like there's no reason it can't be trading 10 times its sales, in terms of being a $10 trillion company at that point. So if you bought it now and it was going to 2.5x between now and 2030, if you knew for sure it was going to do that, you'd buy it today. You wouldn't think twice. But somewhere in your mind, you've convinced yourself that it's gotten to be expensive. And so you go discount shopping on the market to find a company that has something structurally broken, but you think has upside. And I mean, this is like something obviously I do all the time. Like I'm trying to find, like 3 or 4 of my, especially because I can't play in certain tech names that I have, proprietary, material, non-public information about. So like I end up finding things like Viking, where it's like, it's a cool company. It's got a ton of upside, but like, I've literally been sitting on dead money now for like 2 years while I wait for a possible approval to make money. And by the way, I sat on my SoFi deal for like 4 years, making jack dick on that account. And by the way, losing money most of the way through that to get to the point where I end where it returned. So, our opportunity costs in this line of work that we're in is significant.
Well, it's significant as well because how explosive this market is. I mean, it's doubled in matter of like years. Like it's kind of crazy how things are moving so quickly. And I think that's you have to be very selective, essentially, is what we're saying, on where you want to have your working capital or your soldiers pick their battles in now, because what was the old winners is not the new winners anymore. We are actually starting a brand new chapter on the world. It's not like you can't use what has worked 2 years ago and what's going to work the next 2 years. It's totally different. It really is. And I think that a classic example is Let's talk the China news. AMD, Nvidia, China news. Like
Yeah.
that was a lot of people was like, oh, is this pay to play? Is this essentially capitalism is removed forever? I think my interpretation is bullish. I think they finally got access
Is
to a
it ever not?
massive AI market. I know it's hard. Someone made a very interesting comment in a bull market. All news is good news. Bear market, all news is bad news. And it's kind of crazy how accurate that is. Where sentiment drives price action, and when sentiment is this bullish, I see it as half glass full, not half glass empty. But what's your take on the China news before I give mine
Yeah,
on
you had a
AMD and
good
Nvidia?
take. So I'm going to leave you some air on this one, but I mean, mine was very simple. It's a official approval with licensing and tax, and the tax in this case is not really going to be paid by Nvidia and AMD. It's going to be paid by the research and technology companies in China that want to consume this technology. I've said a long time, Huawei is not a competitive product at this point. Neither is CAN, their software. So they have only two options. And then of that, really, all the researchers and developers there are really locked in on NVIDIA. So they're willing to use a 3-year-old deprecated technology, and they're willing to pay whatever it takes to get it. And this is also in regards to the Chinese companies buying it, probably going to be fairly in line, if not still cheaper than what they were paying, because they were getting it through indirect channels and through difficult bootlegged gray market means, right? Now they're getting it directly with proper approvals, and they're going to pay a little bit of a tax. It's going to be passed on by these companies, which, depending on how that all works, might even raise revenue, despite the fact that it's revenue with all costs, depending on how much they raise it. I mean, maybe they raise it and increase margin. I have no idea, but they have all the flexibility to pass it through. The demand and the supply is super asymmetric, and these chips and the desire for them to be utilized in China is much higher than 15%. There's also Trump raising funds. I mean, look, you can agree or disagree with style, but he's finding a way to make money on all the things people care about. And there's a little bit of a give and take here on the whole way China's playing us on rare earth magnet. So there, this is something they really want and need. We know it. The same way with the rare earth magnet that they're doing to us, slow rolling. And so there's a lot of gamesmanship here, but these are the selected winners, not losers. Just be clear, like AMD and Nvidia are the selected winners by the Trump administration to be allowed to sell these and make money. And then, of course, because of the demand, charged through to China.
I mean, I think what I want to spotlight most about what you said was the national security component of this, because this felt like a long runway of he said, she said type of thing, and we're never getting a solution. I think now we finally got what Washington's essentially saying, where you can sell, but only on our terms. Fine. I get the annoyance of the capitalistic lens with that phrase, but this oversight now keeps China dependent on US silicon. And I think that's really important on the national security front, on why that is a thing that we absolutely need to do right now, and not let the potential competition catch up to what Nvidia and AMD is even doing, or Nvidia is really doing right now. And I think that from an investor standpoint, it's not a penalty. It really isn't. It's an access fee to the world's largest AI market outside of the US. And now that you put the guardrails on what that export tariff will be, now there's become a little more predictable on Wall Street on how to guide that going forward. So they actually include the China revenue into their DCF models, and that's gonna be a bump on the valuation just by that alone. And I think that, again, this also removes the constant threat of an overnight policy shift that can erase a 10% of the revenue stream, like for Nvidia, or a potential tailwind for AMD, that we can remove now, because it's a win-win for everyone. Like, Trump gets what he wants. Nvidia and AMD now have access to the second largest AI market, and they can relieve the digestion a bit. This is the Pepto-Bismol that both the companies needed. And I think the ripple effect isn't just for them either. I think this is why you're going to see a potential tailwind on like the connectivity names, like the networking names, like the Broadcoms, the Astera Labs. They become more valuable because the AI server adoption in China means more demand for connectivity solutions that link the Nvidia and AMD chips to all their hyperscaler infrastructure. We're talking Micron. You saw Micron essentially pre-announce really strong numbers that I want to
Yeah.
tout that Daniel was the only one who really was bullish on Micron when nobody else would talk about it. And
Well,
he's
can I just do a quick
yeah.
victory lap? That was one of these very obvious ones that nobody wanted to believe because we so deeply see our historic reference points that we can't unsee what we've seen in the past. And what I said all the way along was that memory was always volatile because memory was always cyclical. So what's the difference, Shy, about this cycle?
Indefinite demand.
It's not cyclical, at least not for 4 or 5 years, right? For the next 4 or 5 years, we know from all the forecasts that we're going to build out X amount of gigawatt capacity, which means X amount of Nvidia, Broadcom, AMD, which means Y amount of HBM. Ray, our semiconductor, I said to him, I said, we're going to model the HBM now that we're modeling all the compute, because once we know how much compute there is, we're going to know how much HBM there is. So my point, though, is that, first of all, I think Micron's still only trading at like 8 times forward. And now you have a company that's trading at 8 times forward that doesn't have the risk, Shy, of having the deep cycles that phones and PCs have. And by the way, SaaS companies, I was looking for the analogy. I just want to go back on this. SaaS companies are getting re-rated to being OEMs.
Whoa.
If you kind of think about what's potentially happening, though, is like, look at how the companies like HP get ranked and how Dell gets rated. They get rated less as more as a kind of a commodity in the channel. So what I'm saying is, and if Satya and Bill and other people are right about SaaS companies becoming deprecated databases, then that's probably right. It's not that all the data is going to leave and not everybody's going to stop using these companies, but they're going to minimize the amount of seats. They're going to use the least that they have to, and they're probably going to have to flip to some model that's based on the amount of data accessed and the amount of tokens. And you put that all together, it becomes a really compelling case that these companies become commoditized if they survive. And then, like I said, only a few of them really make the pivot.
No, it's true. I mean, guys, like, I was so bullish on software just 2 years ago. I get it. It's like a weird flip of a switch, but I think it's also really important to know when you get more and more data, it's really important to like make that pivot so you don't get stuck in mud. Like the post I made over the weekend, my performance the past 3 years, it wasn't because I had a static game plan. It was fluid. It moved when I got more information. And I'm a growth investor. I want more Amazon and Google. That's not a characteristic of a growth investor a couple of years ago, but this is kind of the pieces we're getting now where the commodity of the software space might cause a re-rating to not just be for 25 times free cash flow. In a couple of years, the norm might be 15, 20. And by then, you just had a slow bleed out for the majority of the software space. I do think there's going to be a handful of clear winners. I do think so. It's just that you can't just axe a whole space that has that fluffy of a fundamentals. Like it's really difficult because these aren't money losers. Like they're printing cash. It's up to them. They have very bad tech debts, but the actual fundamentals is they can make a pivot if they wanted to. So we'll see. It's up to management.
Super attractive PE rollups.
Super attractive. Like
if the market doesn't support because they still are printing and they're, there's a positive end game. Let's get back. We lost our train of thought a little bit on this Nvidia and
China.
AMD
Yeah.
stuff.
Yeah.
How about Intel though?
Mm-hmm.
How about Intel?
What's Intel trading at?
But Lip-Bu-Tan, I think they were up today. I don't know what it's up at the moment, but Lip-Bu-Tan goes to Washington, right?
I mean, Intel is trading at 1.7 times price of sales.
Yeah,
it's getting traded like a commodity. Yeah, it's essentially they have zero faith on the board of directors. I don't blame them. It's been an absolute mess the past decade. It's not the CEO's fault on what's happening to the Intel. It's just know that it's not his fault. This is purely bad corporate governance from the board of directors. He is doing everything I would do in his position, cutting the fats, figuring out what the foundation is to stand on before making the necessary pivots. But I think we also got some clarity. I think you made this comment, Daniel, on why Trump isn't touting Intel as much as you'd think as the American foundry, the U.S. foundry. And I think maybe he wants something in return that Intel wasn't willing to give. I don't know what that was, but him going to the White House today. We'll see what comes of it. I think the risk and reward, all the risk and reward in today's market, there's obvious risks. The only ones I want to participate in is clear risk, and it's not as safe harbor as the higher conviction names, the clear winners. But for Intel, I mean, they have such a duopoly that I know they've fumbled it, but at a certain point, like the theme might right, the high tide raises all boats, where even the most unloved kid on the block will benefit from the massive growth in the neighborhood and the facilities. I don't know. What's you're much more close to Intel, so curious on your take.
I actually talked to Lip-Bu Tan around earnings, and I can't talk much about our specifics of the conversation, but going into this whole thing, I thought Intel, going into the Trump administration, actually into CHIPS Act and into the Trump administration, I thought that Intel had to be in just this wonderful position, build here, America first, national security, all the cards technically lined up for them. Like, we want a US-based chip champion that has its own US-based foundry and controls its IP. You know how many companies do that at the leading edge?
Only one.
Only Intel.
Yeah.
TSMC is a Taiwanese company, and despite the positive U.S.-Taiwan relations, it's Taiwanese. And you know where their best IP is? Taiwan. It's in Taiwan.
Exactly. The East.
It's here's the sermon, everybody, as it comes to the chip industry. So if the China-Taiwan escalation turned to war and Taiwan got taken out or China seized control, the node that we're on becomes the end of the line. There is no next node. It's all that technology and all that IP sits in Taiwan. So the fact that we've basically got all our dependents, all our chips, literally all of our chips in the basket, figuratively and literally, with Taiwan is a risk. And Samsung doesn't really fix that for us. And there is no other at the very leading edge. So it was set up perfectly, Shay. They should have had a competitive part, and they should have set up and kissed the ring, whatever it took, of the Trump administration to say 20% or 30% of all the chips made by Nvidia, AMD, Broadcom, Marvell, you just go down the list, the custom chips made by Intel. And that, because it's super expensive from an R&D and an expense standpoint for a fabless designer to design for two different foundries. But now what you ended up having is a complete near monopoly. And that's by the way, on our AI-15, you and I love TSMC. It sits at the top. It is completely in
Literally,
control.
they could wake up one morning. It's like, I want to raise my prices 15%, and everyone will have to buy it still, no matter what.
They've done it recently, multiple times, and they get to continue to do it because there is no pressure on the system. But again, the risk is too high. The resilience is problematic. We, of course, are getting them to spend a lot of CapEx here, which is good, but we should want to have the alternative, and we should want the U.S. to control the IP of its own, the IP that controls its fate as being the world's leader in AI. So here's where I'll leave this one. Whether it ends up being USMC, this United Semiconductor Manufacturing Company, whether it becomes a JV where Apple and Qualcomm and all these other companies chip in and it spins out, whether Intel gets backed and it stays in with the right governance mechanism, everybody out there should actually be rooting for Intel. We need diversification. We need a U.S. champion with U.S. IP in the leading edge space. And that doesn't mean TSMC can't do well. It doesn't mean TSMC can't compete. And it doesn't mean we don't like to see TSMC do well. We consider them an ally, and we consider the work they do to be the best in the industry. But that doesn't leave us in a good position to not have a choice. Even those that love Nvidia should actually want AMD to succeed. They really should. You want the competition. You want the government to not be looking at monopoly issues and different regulatory and antitrust issues. Same thing here, except the difference is we need a U.S.-owned, controlled fab. And so I hope Lip-Bu Tan goes there. I can't speak to his conflicts. I can't speak to whether or not he should or shouldn't exit his positions in China, but he needs to do whatever it takes to get the support of the administration and, of course, get the money to build these things out. And if I'm the if I'm saying something to the Trump administration, the importance of propping this up in some way is much bigger than whatever the cost is.
I mean, well said. I don't think I can add anything more to that. But we at the top of the hour. We have a busy earnings season ahead before we record our next episode on Friday. We got some favorite of my names. We got AST Space Mobile is reporting after the bell in 1 hour. We got Aqua reporting in 1 hour. We got tomorrow morning. We got Circle, which is one of the hotter IPOs in recent memory. We got C Limited, which got beat up a bit past couple weeks. I forgot why that is, but it's one name I'm watching the e-commerce space. CoreWeave, spoiler alert, is probably going to do really well if you looked at Nebius's earnings and you looked at what AI infra has been. Then we got Kava tomorrow. I just had some Kava over the weekend and 40-minute wait, so that was annoying, but it was great.
I met their founder, by the way, at a party I was at.
You did?
Yeah.
Nice.
Guy. Yeah. I like the food though. It's one of the cleaner.
I love Mediterranean. It's up my jam for sure. Then we got Wednesday. We got Cisco after the bell. They've been on the tear as well. And then Thursday we got Applied Materials, Newbank. It's kind of a quietish earnings week compared to last week. I think the following week might be. Is that the Nvidia earnings week? The following week? Is that next week?
2 weeks. In 2 weeks, you're going to be eating wedding cake and trying on garters, and I am going to be. I am going to be bouncing between I'm going to be having a sit down with the CEO of Broadcom that week. So I'll during VMworld Explore. So keep an eye out for that. But also I'll be in New York gallivanting around because we'll have the Nvidia and Broadcom earnings on the 27th and 28th. So I'm gonna miss you though, man. I'm telling you, I know it's only 2 weeks, but I don't know how I'm gonna go get by for those 20 days without potting with you, man.
I just hope there is no black swan event or something that drags my eye to the market.
Can you imagine if you come back and my Twitter game's better than yours? Like you leave.
I fully expect that. I could see that.
I've got the spice. You come back and I'm like, maybe I'll pod with you, dude. Maybe I'll give you my spice. No, I mean everybody out there that doesn't know, Shay's getting out. He's getting excited. He's sharing pictures of his lovely bride to be, and congratulations to you. It's amazing.
Thank you.
Blessing. But he is leaving us for a period of time. And, he's probably going to be sneaking tweets in when he visits the John during meals. And, when she goes to bed at night, you're going to be up just reading, catching up, programming tweets in Buffer, wherever you tweet. There's no way you're not going to have withdrawals. You're going to be walking around town with a ventilator, I need some X, man.
No, I mean, my fiance is she's not a mornings person. She sleeps in. I'm neurotic. I obviously, you guys see how early I get up. So I think I have a couple hours of tweets. Her fiance's parents and family will think I have the worst bladder because I'll probably go to the bathroom and see what's happening in the market on the phone. But yeah, it's going to be a quiet beginning of September, but let's just hope nothing crazy happens and Trump doesn't do some black swan event that causes the VIX hit a 50 handle and I missed out on an opportunity. But anyway, we're at the top of the hour. Appreciate you guys hopping on the special pod. You guys wanted an update on the software space. We spent a ton of time on what our thoughts on the software space is. It's something to watch out for. Keep in mind, look out for the Futurum Equities list of agentic cloud platforms. We're going to call out where the best neighborhoods are on SaaS Avenue and where we think the 10 names are going to be the great place to hide out once that whole bucket is experiencing that FUD pullback. So that's where the opportunity is. So tune in next time, guys. Thank you so much.